because what I'm going to talk today is about like how to identify impact. This is the Impact Festival. So like, what is impact? How are we measuring it? This is actually not a small task. I mean, we all know somewhat how to measure a financial impact, but actually what is real impact? Now, I look at impact as a climate fund with a very, very narrow view. Like, just like a startup, a fund has to have a focus, and our focus is climate. So, of course, social is important, biodiversity is important, health is important, all of those. I have utmost respect for all the founders in that, but our view is very limited. It's on climate. We believe this is probably the biggest irreversible problem of the world, which is why we've decided to tackle climate. And so I'm going to talk on how to find out what impact means in climate. Now, first of all, it's actually very small. This little dot here, this little green dot is how much impact investing is done in climate compared to the entire assets under management. It's like tiny. In Europe, we have 20 trillion assets under management, and climate is pretty much almost neglectable. We need to have a lot more. So we need to have, and it's really not that much, but this is what we would need in climate impact investing, and this is what we would need in the world. So we're here, and actually climate is the only part that is growing at the moment, but still the gap is huge. It's pretty much a 10x we would need to get to net zero by 2050, as said in the European goals. Now, the good thing is I think we have something in Europe, but also in Germany in particular, which is one of the core ingredients. It's actually the research and development. It is the patents we hold for the technologies which are relevant in the climate space. They are actually quite well aligned in Europe with 28%, more than Japan, more than the USA, even more than China. So it's really not a problem of the research part, and I'll get later to what the problem is. Now, so what are those technologies? Is it this? Is it this, like no leather bags? Or is it even this? This is what we got pitched. All of those are real life examples from World Fund. This is a vegan pizza, and nothing wrong against vegan pizza, but it's like, this is not climate tech. And so what we're seeing, and in our impact analysis, that there is a real misalignment into what are the carbon emitting sectors. You see this on the left side. So those are the carbon emitting sectors. You have mobility with 15%, energy, food, agriculture, land use, industry, and built environment. And actually, the biggest chunk went into mobility. So in the scooters, but also cars, lots of other things, while some other areas, most notably actually food and agriculture, are massively underfunded. Food, agriculture, land use, and forestry. So impact is first of all about classifying where should money go in. It's important to classify in what maturity stage, because we kind of have three things. We have things that are at market stage. So there are a lot of technologies which are ready today. We just need to deploy them. Solar is one of those examples. Solar is there. It is the cheapest form of energy. Sure, granted, it doesn't always come exactly at the time when you need it, but it is there. The technologies, if coupled correctly with the demand, then they are there. And there, it's really just about a deployment. How do we get as many solar on the roofs, on other places as fast as possible? Same, of course, with wind, with other things in decentralized energy sources. Then we have the technologies at development stage. So things which will save us in 10, 15 years and so on. And then, of course, we also have those technologies which are held by some parties, not wanting to mention them here, which might hail us in 50 years, but are definitely too late, but are very often used as an excuse to make any other changes. But that is a different thing. But actually, technologies at development stage are equally important, because in 5 to 10 years, that's when the next levers of decarbonization will come. And actually, there's one other number that makes me most sad, but it is unfortunate truth. Behavioral changes is 4%. So it's almost neglectable. Fact is that while we're in this wonderful bubble here, which probably all did some behavioral changes, all the stats say we need to change things with technology, because human beings, unfortunately, are not that good in actually changing unless they're forced to by regulation or pricing. So kind of what we work on is obviously the two other things. Now, And that's the interesting thing. In Europe, we're really strong on R&D. So there's a lot of money in this segment. Also later on private equity rollouts, once it's kind of bankable assets, there's enough money. It was mentioned here that Frankfurt obviously is a city also in sustainable finance, but I would put it to the right here. But what we are lacking in Germany is really this gap of companies who have some sort of technology to then bridge this chasm to a marketable at-scale technology. And that's where, let's face it, the Americans, but also the Chinese are simply much better. And so this is the gap we need to close, not just for climate, but also if we want to succeed as an economy in Europe, in Germany. Now, the good thing, and that makes me hopeful from an investor point of view, is that actually climate IRR in VC is accelerating. So while we all know, you see this on the left side, there was this slump of GreenTech, the first GreenTech wave, the return was abysmal. Now we're getting to over 20% in the last couple of years, while this broader market trend of climate is accelerating. So to sum this up, looking at impact, there's the funding gap in European climate tech, but we're leading with this, and the performance improved. So we do have all the ingredients in Europe, in Germany in particular, to make climate impact. Now this is where you can invest. Very simple call to action. You can just sign up and then you an LP of the fund. No, just kidding. This is actually our white paper. So if anyone wants to look this up, what some more on this, what we just talked about, how the climate scene in Europe has been investing, you can just scan this. It's a 50-page white paper. We've compiled all the data in on climate investing, on the role of Europe, on the role of patents. So feel free to scan that. If you're missing that, I still have it on the last slide again. So now what is impact? Now digging one level deeper on the actual, this was the broader macro level, but digging into the micro level on the actual startup, like a company here, if I walk the halls and it's like, okay, is this company I'm talking there, is this company moving the needle? That's kind of then on the micro level. And this for us, and I want to make this clear here, is not ESG. It's very often confused, ESG versus climate performance. One is simply being a good company, good citizen, environmental, social governance. You all know that Shell, for example, has actually a pretty good ESG rating. I know a couple of friends, they sold their company to Shell, clean tech companies to Shell, and they say, well, one of the first things when they sold their company to Shell is they have to make sure, and they seriously enforce that, to hold the handle every time you walk up or down the stairs. It's part of their safety requirements, and they're very good at this. Of course, the business model is terribly destroying the planet. You can be a company in strong ESG, but you have a terrible business model, and vice versa. I think Tesla is a good other example. I think they've been the leader in automotive, driving the electrification. Not sure how good their social governance is. Now, this will be the topic also of my colleague Stefan Vogel, who joins in the panel afterwards, and three other people who will talk about this aspect. So it's a different one. It's important, but it's not what we would call impact. So for our case, it's really about the impact of an actual business model, and really important to not confuse the two. Now, actually, I shouldn't say impact. This is the Impact Festival here, but at the very beginning, when we started the World Fund 2 years ago, we thought we want to get away from the term impact, because there's always the question next is like, what's the trade-off between impact and profit? And that's actually a very wrong way to approach it. And so we said, okay, let's forget the term impact. We actually coined the term climate performance potential, because at the end of the day, a company can only have impact if there is a performance of the company, and even going even further, a climate performance potential. So the potential of a company to decarbonize a certain industry, for us, is an indicator for financial performance. So it's not a trade-off. Either a company is successful in decarbonizing an industry, for example, then they have an impact, but they also are financially successful, or they are not successful at all. They will go bankrupt as a company, but they also don't have an impact. So it's not a trade-off. Now, we started with this core hypothesis. Then we said, okay, how do we go into this? We put it all together and said, okay, let's look into, we started with life cycle assessment, market predictions, all of that. That was our first version of looking at impact. And our game plan was, okay, there must be something out there. Let's work with a leading researcher, find the best methodology. We reached out to finance, to science, public policy, and everything. Published some initial ones, and in the market, we then found nothing. There really was nothing 2 years ago on impact and how to measure the climate performance potential of startup. All the solutions were complex, enterprise heavy, and very much exposed. And so we're like, okay, we need to develop our own methodology. And this should be pragmatic, it should be startup focused, and it should be ex ante, so looking at it earlier and have a VC fit. Because if you walk the halls here today, the question you want to answer is, if this technology would be deployed today, what would be the impact of this technology in the next 10, 20 years to come? And that's really not how you look at if you have a purely existing technology where it's very clear. So we focus and start with by quantifying kind of one dimension, then qualify, assess other, try to align it in a general regenerative approach, seeing how does it fit also with other industries, and then overlay that. And I know that sounds very abstract, with a theory of change. What I mean with that is, for example, we cannot assume that the energy mix stays the same over the next 20 years. The energy mix, fortunately, is going massively into more renewables. So, of course, the carbon footprint of 1 kilowatt hour today is much bigger than the one later in maybe 10 years from now. And with the startup focus, the interesting thing is a startup is the opposite of a peer review. So you have to be very, very pragmatic. It's really just kind of duct tape, so to say, any approach in startup. And we wanted to have that same here. And if you look at startup projections, they tend to be like this. It's like, this is the actual revenue, and then this is the famous hockey stick. And the same projections happen in climate. You look at, okay, if the impact is there, then how will the climate potential develop? And then you come back to basically what you all know as the S-curve. So if you look at all and I'm sure you've seen those curves, you can pick any one. This is the technology adaptation rate. So for example, let's pick one. Let's pick the microwave here. It comes, it at some points accelerates, and then it saturates. Computers, same thing. Internet, same thing. It's the famous S-curve of developing technologies. And we believe that the same actually applies for superior technologies in climate, where if there is a superior technology and that technology then displaces the incumbents, then it will follow those sort of patterns. Now, the last few slides were super abstract. We have a head of impact. He's much better in explaining them. I have to admit, I also sometimes only understand half of it. But I will get very briefly, last two minutes, get into a very practical example so that you can see how we measure it. This is the example from a company of ours called Planet A Foods. They were initially called Coa because their first product is a synthetic cocoa. So they use grain and also the spelt, so the leftovers from grain to produce cocoa with precision fermentation. And now first time when my co-founder Daria brought this deal to us, I was like, well, where is the climate impact of this? And very often it's actually the interesting thing. Some things where we think it's climate impact doesn't move the needle, and other things where we think like, why is this climate, are moving the needle. Now in this case I learned, and I didn't know that before, is that cocoa, just like palm oil, is responsible for a huge chunk of deforestation. And so that is the actual lever. By reducing the cocoa usage, you reduce deforestation. You can also apply the same technologies to palm oil. That will be the next thing, basically synthetic palm oil from grains with a much lower CO2 footprint. And then it looks kind of very similar, very simple. We would look at, okay, we have traditional cocoa here, and that has then in cultivation, transport really isn't important, but in cultivation, it would have 65 tons 65 tons of CO2 per ton. And that's really mainly because of the deforestation. And then you have the substitute product, in this case, coa, the coa product of them, which should only be, so it's a bit more in manufacturing because, of course, those grains need to be processed, but then the actual production of grains have a much lower CO2 footprint, and you end up with 5 tons, which is a 94% reduction of the CO2 footprint. And that would be a typical type of analysis where we look at this. Then, of course, also comparing, as I said, it's also part of a more dynamic environment of the competing pathways. So what other things? What about fair chocolate? What about other ways of sourcing cocoa from different countries need to be compared with other solutions? That is part of the analysis. And then there again, you find the S-curve you saw earlier, looking at, okay, how could the adoption of a product like that, which of course will not displace the Lindt chocolate, but it will displace the cocoa coating of a Mars of basically 90% of the products, because it's cheaper to manufacture, it has better CO2 footprint, and so on and so forth. How will that displace it? And that, of course, is then the assumption that goes into our climate performance potential. That we have developed over the last 2 years. A lot is in that white paper you saw there, if you want to read this up further. And most of the credit goes to my colleague Daniel on this. And that's kind of the final thing, our goal, and that's also the invitation to the audience here, is where we open source this framework. The methodology, we're contributing to Project Frame, which is a big project in this measurement space. We've started the Venture Climate Alliance together with some top, mainly US VCs, USV, for example, Energy Impact Partners, Tiger Global. Not sure if we should keep them on there for the time being, but yes, they're also one of the top VCs, despite some of the rumors which came up. So, but a lot of really good ones adopting this joint measurement framework, because that's the only way, if we have some sort of common understanding on how we can tackle this together. And this is an invitation also to you here, if you're more interested. Write me an email. Unfortunately, I have to catch a train after that, but write me an email if you want to exchange some things, if you want to adopt it for your own things. It's basically something we're also giving out for free, because, yeah, we really think we can only solve this together. We're also working on a publication together with TU Berlin. Vanessa Bach, who's one of the advisors in the fund, Professor Vanessa Bach, she's been quite active in this, also putting a scientific framework on this. And yeah, so the more people start really taking the climate performance potential as part of their investments, I think the better our investment decisions will be when it comes to decarbonization. And I think that's what we're all here about. And with that, thank you very much. And yeah, would love to hear from you. Tim@worldfund.vc is my email. And thank you very much.